Hi guys, my name is Tom. Welcome to this week's video on explaining the term the Greeks. Over the course of weeks and months, we're going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, don't forget to click the link above to subscribe to this page and receive alerts when they are posted. So let's jump into this week's topic, which is explaining the term the Greeks. Greeks is a term used in option market to describe the different dimensions of risk involved in taking an option position. These variables are called Greeks because they are typically associated with a Greek symbol. Each risk variable is a result of an imperfect assumption or relationship of the option with another underlying variable. Traders use different Greek values such as delta and theta and others to assess options risk and manage option portfolios. Greeks provide a way to measure the sensitivity of an option's price to quantifiable factors. Again, Greeks provide a way to measure the sensitivity of options price to quantifiable factors. Let's jump first into the top two most popular Greeks, delta and gamma. And over the course of weeks, we're going to explain more what each term means in detail. Because, trying to predict what will happen to a price of a single option or position involves multiple options as a market change can be difficult. Because the option price does not always appear to move in conjunction with the price of the underlying asset, it is important to have an understanding what factors contribute to the movement in the price of an option and the effect they will have. Deltas try to bridge that gap between misinformation. So Greeks provide a way to measure the sensitivity of options price to quantifiable factors. Delta measures the sensitivity of the options price relative to change in the underlying asset price. Positive delta means that an option position will become more valuable as the stock price rises. I'll repeat, a positive delta means that an option position will become more valuable as the stock price rises. A negative delta means that the option value will increase as the underlying asset value decreases. Gamma measures the sensitivity of an option delta relative to the underlying asset price movement. Gamma is positive for long calls and long out positions, and has the same value for equivalent at-the-money calls and puts. A low gamma means that a large shift in the stock price will be beneficial, whereas a high gamma signifies that even small shifts in the stock price will be beneficial to the option positions. So you use gamma to look at, what's the volatility? It's very volatile. It's definitely going to affect the gamma. Very sensitive to small price movements. And that way you kind of trying to understand why there's a difference between different option prices. Because as I mentioned earlier, sometimes the stock might move a lot, but the underlying option price might not move. This could be one of the factors. Let's continue. Let's look at three more. Theta, Vega, and Rho. Theta measures the sensitivity of the option price relative to change in time left to expire. We talked about expiration a lot. Time left to expire is expiration. For long opposite positions, theta is usually negative, signifying that time decay hurts the long opposite position, and that passage of time will reduce the value of that position, hurting the underlying premium price. For combination option trades, theta can be positive, showing that time decay can help the spread position. Depending on how you're looking to trade, the closer to expiration could help you with making money, the longer out could hurt you. So that's where theta comes into it, looking at the time decay. Vega measures the sensitivity of the option price relative to change in the asset's volatility. Vega is always positive for long option positions and is identical for the equivalent at-the-money calls and puts. A high positive Vega signifies that small increases in volatility will be helpful to the option position, whereas a low Vega signifies that a high volatility will be required to augment the options position. Rho, finally, measures the sensitivity of the option price relative to changes in the risk-free interest rate. High interest rate will be beneficial to calls and detrimental to puts. Also, the longer the time to expiration, the greater the value, positive, negative Rho will have. So all five of them, so delta, gamma, theta, Vega, and Rho, are the most common Greeks that you hear about. They are, it's good. They're the most, there's other minor Greeks out there, but getting understanding of those 5 ones is probably the best way. It's probably a good starting point for you all. Thank you so much for watching this week's video on explaining the Greeks. We're going to continue looking at different, over the coming weeks, we're going to continue breaking it down further. If you like this page, please check out our website, and at the link, please also subscribe to our YouTube channel. Also, we post regularly on our social media accounts, Facebook, Instagram, and Twitter. And stay tuned for new content next week. Thank you.